Every time you reach for your smartphone, or maybe power up your computer, or even just drive a modern car, you're interacting with this uh, complex web of tiny electronic components.
Yeah, absolutely.
And these aren't just magically appearing, right? They're made possible by a few absolutely critical, maybe unsung giants of industry. Today, we're pulling back the curtain on one of the biggest.
That's right.
Welcome to the Deep Dive. We're embarking on a journey into Tokyo Electron Limited, or TAL. Now, this company is a true cornerstone of the global semiconductor manufacturing industry. We've been given a pretty comprehensive stack of sources, investment analyses, financial reports, recent news to unpack
A
here.
lot to get through.
Yeah, and our mission is clear. We're here to extract the most important nuggets of knowledge, really cut through all the complexity, and deliver you the critical insights about this, well, fascinating company.
Exactly. And you can expect us to explore TEL's strategic positioning, you know, dive into its undeniable financial strength, examine the competitive advantages that truly make it a titan in its field, and analyze the powerful forces, both opportunities and risks that are shaping its future.
Right.
This isn't just about a stock symbol. I mean, it's about understanding the actual engine room of our entire digital world. #I, Executive Summary Investment Thesis Overview, setting the stage for the deep dive.
Okay, so let's dive right in. When we talk about Tokyo Electron, we're talking about a name that most people probably don't know.
Not a household name, no.
No, they're not making the chips themselves, like Intel or NVIDIA. But without them, those chips simply wouldn't exist. They are an absolutely essential supplier in what's called the wafer fabrication equipment market, or WFE.
That's the key term, WFE.
Yeah. Think of them as providing the ultra-precise tools for the front end of line processes. That's where the actual microscopic transistors get created on a silicon wafer. The tiny switches that make everything digital possible.
And what's truly fascinating here, I think, is that their role isn't just important, it's practically indispensable. They operate within a highly concentrated industry, what we often call an oligopoly, playing just a foundational part in technological innovation.
An oligopoly, meaning
Yeah.
just a few big players dominant.
Exactly. If you want cutting-edge chips, you need companies like TL. There aren't many alternatives for what they do at the highest level.
Every truly great business has some kind of competitive edge, a moat around its castle, right?
Yeah.
What truly anchors TL's market position? What makes them so resilient?
Well, the most striking thing I think that jumps out from the sources is their near monopoly. I mean, they hold a 100% market share in coder developer systems for extreme, ultraviolet, or EUV lithography.
100%.
100%, which creates this deeply symbiotic, mutually dependent relationship with ASML. ASML, as you probably know, is the sole provider of the most advanced EUV machine.
Right, good big lithography giant.
Exactly. And you literally cannot use ASML's state-of-the-art EUV equipment to make next-generation chips without also using TTEL's coder developer.
Wow. So they're locked together at the hip for the most advanced stuff.
Completely. It makes them a kind of choke point in leading-edge production for the giants. TSMC, Samsung, Intel, they all need this combo.
A choke point. That's a powerful position.
It really is. And beyond that unique position, they also hold number one or number two global market shares in numerous other critical process steps. Things like other coder developers, gas chemical etch systems, diffusion furnaces, batch deposition, probers. The list goes on.
So dominant across the board, really.
Very strong positions, yes. And all of this is underpinned by a massive intellectual property portfolio. We're talking 23,249 patents as of their last fiscal year.
23,000 patents.
Yeah. And they back that up with just a staggering commitment to R&D JPY, 1.5 trillion planned over the next 5 fiscal years. That's over $10 billion.
Whoa. Okay, so that's the competitive side. When we look at their financial health, is that just as strong? Does the money follow the moat?
It absolutely does. If we connect this to the bigger picture, you'll see TAL exhibits all the hallmarks of a mature industry leader. We're talking robust profitability, consistently strong cash flow generation, and critically, pristine debt-free balance sheet.
Debt-free
Yeah.
in this capital-intensive industry.
Essentially, yes. Which is remarkable. These aren't just good numbers on a page. This financial fortress gives them enormous strategic flexibility. It allows them to aggressively invest even through the industry's often severe cyclical downturns, ensuring they emerge even stronger.
Right? They can keep spending on R&D when others might have to pull back.
Precisely. Now, their performance naturally is intrinsically linked to the capital expenditure cycles of their concentrated customer base. Those big names we just mentioned, Intel, TSMC, Samsung.
So their fortunes rise and fall with the big chip makers' spending plans.
To a large extent, yes. Now, the investment landscape for Tel-El, and this is really for you, the listener, it's a really interesting mix. You've got these powerful secular growth drivers like the explosion of artificial intelligence, right? The increasing complexity of advanced packaging for high-performance computing and the growing semiconductor content in cars and all those IoT devices. These are strong, long-term tailwinds.
Definitely seeing those trends everywhere.
But they also face significant multifaceted headwinds. Geopolitical tensions, particularly the U.S.-led export controls targeting China, which, as we'll see, is a major market for Tel-El, introduce considerable uncertainty.
Ah, the China factor. Always complex.
Always. And then, of course, there's the inherent cyclical nature of the memory market, which can be quite volatile. Swings up and down.
So, okay, wrapping this overview up,
Mhm.
what does this all mean for you, the listener? The central questions here really revolve around sustainability, don't they?
Exactly. Can Tel's formidable competitive advantages and those high returns truly withstand demanding valuations? Can they navigate these powerful secular growth trends alongside the unpredictable nature of global geopolitics and industry cycles?
That's the core tension, isn't it? That's what we aim to help you understand today. Hashtag Tag2. Industry dynamics and market position. Understanding the semiconductor ecosystem.
So to really grasp TEL's importance, we first need to understand the incredibly intricate journey of actually creating a semiconductor chip. I mean, think of it like building a hyper-advanced microscopic city. It's not simple.
A microscopic city. I like that analogy.
It's a globally distributed and highly specialized process, and you can broadly segment it into three main stages. First, you have the upstream, which is really the design stage. This is dominated by fabulous companies, think NVIDIA, Qualcomm, who design the blueprints for the city but don't actually pour the concrete.
They're the architects.
Exactly. And then you have intellectual property core providers like ARM, who design the underlying infrastructure, like the power grid or the plumbing for that city.
Okay, upstream is design. What's next?
Next is the midstream. This is the capital-intensive core, the actual fabrication, the building of the city. Here you find integrated device manufacturers, or IDMs, folks like Intel and Samsung, who design and manufacture their own chips. They're building their own cities from scratch.
Design and build. Got it.
Then there are the pure play foundries, like the giant TSMC, who manufacture chips for others based on their designs. They're the master builders for hire.
Like construction companies for chips.
Precisely. Now, the fabrication process itself is further divided into two critical parts. You've got the front end of line, or FEL. This involves hundreds, literally hundreds of steps to create the actual transistors and circuits directly on the silicon wafer. This is by far the most technologically complex and capital-intensive part, laying the very foundation of our digital city.
That sounds like where the real magic and the real difficulty lies.
It absolutely is. Then comes the back end of line, or BEOL. This involved creating the metal interconnects that wire everything together. Think of it as installing the roads and communication lines in the city, followed by packaging and testing.
Okay, EEOL is building the core components. BEOL is wiring them up. And the last stage.
Finally, you have the downstream, often called OSAT, which stands for Outsourced Assembly, Test, and Packaging. This is where the finished wafer is cut into individual chips, encapsulated in protective packages, and undergoes final testing before being integrated into electronic devices. Think of it as the final inspection, putting the roofs on the buildings and delivering the finished products.
Okay, that makes sense. And TA focuses squarely on that incredibly complex midstream part, specifically the front end of line, correct?
Precisely. Tokyo Electron is a pure-play midstream equipment supplier, exclusively providing critical machinery for that complex, crucial AVOL stage. And this isn't just an important segment, it's the most valuable part of the equipment market. We're talking over 60% of the total wafer fab equipment spend.
60%. So they're right in the sweet spot.
Right in the core. And it's projected to grow at a compound annual growth rate, a CAGR, of around 8.78%. So T-TEL is positioned right at the very heart of semiconductor fabrication. Their product portfolio addresses those foundational FEOL processes. Deposition, that's like atom-by-atom material layering, incredibly precise.
Yeah.
Then etch, which is the precise carving away of material to create circuits, meticulous cleaning at every single step.
Yeah.
And of course, lithography support, especially those absolutely critical coder developers we talked about.
That sounds like a massive and growing market then. How big is this space overall? And what are the big trends really driving all of this relentless demand?
Oh, this market is enormous and, as you said, experiencing incredible secular growth. The wafer fabrication equipment market, the WFE market, was valued somewhere around $108 billion to $110 billion in the 2023-2024 timeframe.
100 billion plus. Okay.
Yeah. And industry forecasts project a robust expansion, with market size estimates ranging anywhere from $190 billion up to maybe $270 billion by the early 2030s.
Wow. Potentially more than doubling.
It implies a sustained CGR between, say, 6.85% and 10.6% for essentially the next decade. It's a huge growth story.
And what's truly driving this? Is it just Moore's Law continuing or something else?
It's driven by several powerful long-term secular trends, not just one thing. Artificial intelligence and data centers are perhaps the primary engine right now. The build-out of AI infrastructure demands just vast quantities of high-performance GPUs, custom processors, and that high-bandwidth memory, or HBM, we'll talk more about.
The AI revolution needs hardware.
Tons of it. Then you have automotive electrification and autonomy. The increasing amount of semiconductor content in vehicles, driven by EVs and advanced driver assistance systems, ADAS, is creating a large and growing end market. More chips in every car.
Right. Cars are becoming computers on wheels.
Exactly. And of course, the Internet of Things, or IoT and 5G, the proliferation of connected devices everywhere, homes, factories, cities, continues to fuel demand for a wide array of sensors, microcontrollers, communication chips, billions and billions of small chips.
Okay, so multiple strong drivers. Geographically, where is all this equipment going?
Well, the market is heavily concentrated in the Asia-Pacific region. That area accounted for somewhere between 47% and maybe up to 68% of the total market in 2024, led, of course, by the massive manufacturing hubs in Taiwan, South Korea, and China.
Still the dominant region.
For now, yes. But while Asia remains the largest market, North America is projected to be the fastest growing region going forward. And that's a direct result of these government-led initiatives like the U.S. CGPS and Science Act, which aims to onshore and friendshore semiconductor manufacturing capability.
Right, bringing chip making back or closer to home.
Exactly. A big shift is underway there.
So within this massive and growing global market, where does Tokyo Electron truly stand among its rivals? You mentioned the oligopoly.
Yeah, within this expansive market, Tokyo Electron stands as one of the dominant players. As I said, the industry itself is structured as an oligopoly. Just a few key companies control the vast majority of the market share. Tellurol is actually the world's fourth largest semiconductor production equipment manufacturer overall, with sales hitting JPY 1.83 trillion in its fiscal year 2024.
Fourth largest. Okay. Who's bigger?
Ahead of them, you typically have Applied Materials, ASML, and Lam Research. But Tellurol is right there in that top tier. And their competitive strength is really evident in their specific market leadership across various product categories. According to their own estimates, they hold the #1 global market share in coder developer, gas chemical etch systems, diffusion furnaces, batch deposition, and probers.
#1 in quite a few critical areas.
Yes. And they're #2 globally in cleaning, plasma etch systems, and metal deposition. So what this means is that in almost every critical step of that complex front-end-of-line process, Tellurol is either the leader or a very close second. Very strong position.
You mentioned the 100% market share for coder developers in advanced EUV lithography earlier. That number just screams competitive edge. Why is that so incredibly significant? Can you break down what these coder developers actually do again?
Yeah, absolutely. It really gets to the heart of their unique competitive moat, that EUV position. To understand why the coder developer is so critical, think of lithography like a highly precise photographic process on silicon. ASML's EUV machine is like the world's most advanced camera, right? It prints these microscopic circuit patterns onto the silicon wafer using extreme ultraviolet light.
Okay, ASML is the camera.
Right, but Tellurol's coder developer is like the essential darkroom setup before and after the picture is taken. First, Tellurol's coder perfectly primes the silicon wafer, coating it with an incredibly uniform, thin layer of a light-sensitive chemical called photoresist. It has to be perfect.
That prepares the film, basically.
Exactly. Then, after ASML's machine has exposed the wafer with the circuit pattern, the wafer goes back to Tellurol's developer tool. This meticulously washes away the exposed or unexposed photoresist, depending on the type, to reveal the incredibly tiny patterns that ASML just printed.
Ah, so it develops the image.
Precisely. Without TEL's equipment meticulously preparing the surface and then developing the pattern, ASML's amazing camera simply has nothing functional to work with. The whole process fails.
Wow. Okay. So for cutting-edge EUV lithography.
For cutting-edge EUV, TEL's tools aren't just an option. They are the industry standard and, as far as we know, mandatory to use with ASML's EUV systems. This creates that powerful, unique, competitive moat we talked about. It effectively locks TEL into the most advanced and profitable segment of the industry.
And links their growth directly to ASML's success with EUV.
Directly. It links their growth to next-generation process nodes and gives them significant pricing power. The real insight here, I think, is that TEL isn't just selling a machine. They're selling access to the future of chip making at the very highest end.
Access to the future. That's a powerful phrase.
It really is. This isn't just about market share today. It's about holding a foundational leverage point that ensures their relevance and profitability at the cutting edge for potentially decades to come, almost regardless of who actually designs or builds the final chip.
That's a fascinating choke point.
Yeah.
Now, let's talk about maybe the double-edged sword of their business. Geographic exposure and customer concentration. You mentioned the big three customers.
Yeah, right. Their revenue base is global, but it's incredibly concentrated. Their three largest customers, Intel, TSMC, and Samsung, accounted for a combined 43.2% of total sales in fiscal year 2023.
Almost half their business from just three companies.
Exactly, which means the capital expenditure plans and, the technological choices of a very small number of companies disproportionately impact TTEL's financial performance. It's a risk.
Definitely. And geographically, where are the sales happening now?
Looking at their geographic sales mix for the fourth quarter of fiscal year 2025, China represented 34.3% of their sales, Korea was 22.4%, Taiwan 20.7%, Japan 8.1%, North America 7.1%, and Europe was smaller at 3.1%.
China, still the largest chunk then, even after some discussion about a peak.
Yeah, still the largest. But that China revenue dynamic is particularly interesting and volatile. In quarters prior to Q4 FY 2025, China's share of revenue had been consistently above 40%.
Right, that was the boom time.
Yeah, and this wasn't necessarily for the most cutting-edge technology, which is restricted by U.S. export controls, as you know. Instead, it reflected this policy-driven surge in investment by Chinese firms aiming to build domestic capacity in mature, non-sanctioned process nodes, think chips for cars, industrial applications, that sort of thing.
So trying to become self-sufficient in the areas they weren't blocked from.
Exactly. And this created a significant revenue boom for TEL selling those mature node tools.
But there's been this recent inflection point, as you noted, with that decline to 34.3% in Q4 FY 2025.
Yeah.
What's the thinking there? Is the boom over?
Well, management attributed this to a couple of things. Partly a pull forward of shipments into the prior quarter, meaning some orders got delivered early, and also what they called a peak out of capital investment by emerging customers in China.
A peak out. That sounds concerning.
It introduces uncertainty. What it essentially suggests is that maybe the initial wave of, let's call it catch-up or just-in-case investment by Chinese firms in mature nodes might be moderating, or perhaps that the Chinese domestic supply chain for those types of tools is starting to develop more capabilities. It's hard to say for sure.
So is this peak out just a temporary blip, or does it signal a longer-term slowdown in China for TEL? How much of a risk is that going forward?
That's really a critical question, isn't it? The implication is that future revenue from China may be more volatile and heavily dependent on the next phase of China's industrial policy, whatever that might be. And of course, any further U.S. restrictions or potential Chinese retaliatory measures could introduce significant uncertainty to TEL's growth outlook. So it's definitely a key area for investors to watch very closely. #tag3. Competitive advantages and strategic positioning building durable moats. So TEL's most significant competitive advantage, really beyond that unique EUV position we discussed, is its deep technological expertise. It's relentlessly driven by innovation. I mean, they don't just participate in the semiconductor industry, they truly lead many segments.
And what really sets them apart strategically?
What truly sets them apart, I think, and creates this powerful platform effect for their customers is their unique integrated offering. TEL uniquely provides equipment for 4 consecutive key processes in that critical patterning sequence we talked about.
Yeah.
Deposition, lithography, specifically their coater developer, etch, and cleaning.
4 steps in a row from one company.
Exactly. While competitors, like Applied Materials or Lam Research, might offer best-in-class tools for individual steps, none match TLL's integrated offering across this entire critical workflow.
So for a chip maker, why is it such an advantage to get all those consecutive steps from a single vendor, like TLL, rather than maybe picking the absolute best tool for each individual step from different companies?
That's a great question. It really comes down to precision and efficiency in a hyper-complex environment. When a chipmaker develops a new process node, which is incredibly difficult, utilizing a single vendor for such a crucial sequence simplifies the whole process integration immensely.
Less finger pointing when something goes wrong.
Well, partly that, yeah. It shortens development time because the tools are designed to work together seamlessly, and it makes it significantly easier to diagnose and resolve any yield issues problems where chips aren't coming out perfectly. Think of it like a symphony orchestra. You can have individual virtuosos, sure, but if they all know how to play together seamlessly under one conductor, the performance is far superior and easier to manage.
Okay, that makes sense. Better integration, faster troubleshooting.
Right, and this deepens the customer relationships and crucially raises switching costs. It's not just about swapping out one tool. You might have to re-optimize an entire sequence, which is hugely expensive and risky.
That makes them sticky.
Very sticky. And this technological leadership is sustained by that massive R&D commitment we touched on. The company plans to invest over JPY 1.5 trillion in R&D and another JPY 700 billion in capital expenditures over the 5-year period starting FY 2025. Their R&D expenses alone hit JPY 250 billion in fiscal year 2025.
That's just a colossal R&D budget. I mean, over $10 billion for R&D alone over 5 years. But is it really defensible? Couldn't a competitor just decide to outspend them or maybe get lucky with a breakthrough?
It's a valid question, of course, but in an industry where technological advancement is absolutely paramount, this sheer scale of R&D combined with that existing IP portfolio, remember those 23,000 patents, forms an incredibly significant barrier to entry. Those patents aren't just legal documents, they form an intellectual fortress.
Hard to replicate that overnight.
Impossible. It makes it virtually impossible for any new entrant to challenge their dominance in core processes without embarking on a decade-long, multi-billion-dollar R&D race.
No.
And even then, success isn't guaranteed. It's not just about throwing money at the problem. It's the accumulated expertise, the integrated platform, and the patent protection that makes their position extremely strong.
Okay, so the tech and R&D is one huge moat. What about customer relationships? You mentioned switching costs. Imagine you're a chip maker building a multi-billion-dollar factory, a fab. Once you've painstakingly fine-tuned a piece of machinery for years, maybe tweaking it constantly to achieve the precise specifications you need for yield, how likely are you to just rip it out and replace it with something new from a competitor? Not very right.
Not very likely at all. That really captures the essence of the tool of record concept. Semiconductor manufacturing, as we've said, is incredibly complex and precise. We're talking hundreds of steps where tiny variations, nanometer-level variations, can ruin an entire batch of chips worth millions.
High stakes.
It's extremely high stakes. So once a chip maker qualifies a specific piece of equipment, like a tel etcher, as a tool of record for a high-volume process, switching to a competitor's machine is immensely costly and risky. It's not like swapping out a printer.
What would it involve?
Oh, it would necessitate a complete, costly requalification process for the new tool, and probably the surrounding process steps too. This could easily lead to production delays, yield excursions, meaning periods of lower output or defective chips, and millions, potentially even billions, in lost revenue if a major production line goes down or is delayed.
So the incentive is to stick with what works.
Absolutely. Intel leverages this brilliantly by deeply embedding its operations within those of its customers. They don't just sell a machine and leave. They provide comprehensive after-sales support, they have engineers working on-site collaborating with the fab engineers, and they engage in joint development programs for future technologies.
So they become partners, almost.
Exactly. This creates crucial long-term partnerships and, importantly, a vital feedback loop. TEL gains invaluable insights into the future challenges their customers are facing, which in turn directly informs its own R&D roadmap, further solidifying its incumbent position. It's a very virtuous cycle for them, a very sticky business indeed.
And how critical is their global operational footprint in all of this? I mean, you mentioned these fabs are running 24/7 all over the world, Taiwan, Korea, U.S., Europe.
Yeah, to serve a global customer base whose fabs operate literally around the clock, a worldwide operational footprint is absolutely essential. You can't support a fab in Arizona from an office only in Tokyo. TEL maintains a robust network of R&D centers, manufacturing sites, and service hubs across the United States, Europe, and Asia. And remember, approximately 90% of its sales originate outside of Japan.
90% export. Wow.
Yeah. This global scale allows them to provide rapid on-site support, getting engineers and spare parts to a fab quickly and collaborate closely with customers in every major semiconductor manufacturing region. This is just critical for maintaining that uninterrupted 247 fab operation. Downtime is incredibly expensive.
Makes sense. And operationally, are they efficient?
Very much so. The company has a proven track record of operational excellence. They've consistently demonstrated an ability to improve manufacturing efficiency, shorten production lead times for their complex equipment, and they've maintained disciplined control over their selling, general, and administrative expenses, the SG&A costs, even during periods of rapid sales growth.
So they manage costs well.
They do. And this operational efficiency contributes directly to their strong and resilient profit margins. And again, thinking about barriers to entry, the sheer capital and logistical requirements to replicate such a global sales, service, and manufacturing network represent another substantial barrier for any potential new competitor. It's not easy to build that kind of global machine.
Okay, so these strategic advantages, the tech, the R&D, the customer lock-in, the global scale, they clearly translate into impressive financial metrics, as you said. But how do TEL's margins and capital efficiency really stack up against its closest competitors in this WFE oligopoly? Are they leading the pack financially, or is there maybe room to improve compared to, say, Applied Materials or Lam Research?
That's a key question for you, the investor, definitely. The company has set some pretty ambitious long-term targets. They're aiming for 35% or more operating profit margin and 30% or more return on equity, or ROE, by the fiscal year ending March 2027.
35% operating margin is high.
It's ambitious, yes. In its fiscal year 2025, Tela achieved a 28.7% operating margin and a 30.3% ROE. So they're showing strong progress towards these goals, especially on the ROE front.
Okay, almost 29% up margin now. How does that compare?
Right. So to benchmark this, let's look at some recent comparable quarters. Applied Materials, often seen as the industry's largest player overall, reported a non-GAAP operating margin of 36.4% for its semiconductor system segment, so even higher, actually.
Yeah.
Lam Research, a key competitor, particularly in etch and deposition, reported a 34.4% non-GAAP operating margin, so also a bit higher than TEL's recent number.
Interesting. Both AMET and Lam ahead on operating margin recently.
In those specific recent reports, yes. Then you have KLA Corporation.
Yeah.
Now, they specialize in a distinct and generally higher margin niche process control and inspection tools, metrology. They reported a formidable 44.2% operating margin.
Wow, 44%. That's a different league.
It is, but it reflects their different, more specialized business model. So what this comparison indicates is that TEL's profitability is very much in line with its most direct, broad-based competitors like Applied Materials and Lam Research over a slightly longer view, reflecting a similarly strong competitive position overall. They're in the same ballpark.
So KLA's margins are noticeably higher, though. Why is that exactly? Is it just less competition in their niche?
Yeah, KLA's higher margins largely reflect that specialized business model in process control and inspection. It's a very high-value, high-margin niche with fewer direct competitors compared to the big deposition and etch markets where TEL, AMAT, and Lam battle it out more fiercely. But while TEL's margins might trail KLA's more specialized model, its consistent high ROE, remember, over 30% recently underscores its really efficient use of capital.
Good point about the ROE.
Yeah. And its potential to reach that ambitious 35% margin target will likely hinge on increasing the sales mix of its highest value-added products, particularly its dominant high-margin EUV-related tools. The real insight here is that while they are already performing strongly, there's a clear pathway for further margin expansion as those most advanced EUV-intensive nodes become more prevalent in chip manufacturing. #MARV, financial performance and growth analysis decoding the numbers.
Okay, let's dig into those numbers a bit more. When we look at TEL's sales over time, we really see that powerful long-term growth of the industry. But also, as you mentioned, its inherent cyclical nature. It's truly a roller coaster, isn't it? Significant ups and downs reflecting the broader semiconductor market cycles.
Absolutely. Roller coaster is a good word for it.
Let's trace a recent 5-year cycle, maybe from fiscal year 2021 to fiscal year 2025, just to illustrate this. In fiscal year 2021, their net sales were around JPY 1.4 trillion, 1,399.1 billion. That was showing strong growth as the industry started recovering from the initial pandemic shock.
Right, demand picked up strongly then.
Then boom, fiscal year 2022, sales surged dramatically, up 43.2% to just over JPY 2 trillion, 2,000 or 3.8 billion. That was driven by widespread capacity additions across the industry, everyone rushing to build more fabs.
A huge investment cycle.
The cycle peaked in FY 2023, with sales growing another 10.2% to a record JPY 2.2 trillion, 2,209.0 billion. But then the brakes hit. As the memory and PC markets entered that significant downturn we talked about, TL sales declined 17.1% in FY 2024, down to JPY 1.8 trillion, 1,830.5 billion.
A pretty sharp drop, yeah. Typical cyclical correction.
But the roller coaster went up again. The market rebounded sharply in FY 2025, fueled by all that AI-driven demand and a strong recovery in the memory sector. TL sales hit a new all-time high of JPY 2.4 trillion, 2,431.5 billion, a massive year-over-year increase of 32.8%.
Incredible bounce back. This pattern really underscores the high volatility of the company's revenue stream. While the long-term trend is undeniably positive, up and to the right, you, as an investor, must be prepared for periods of significant year-over-year declines during these broader industry downturns.
You need a strong stomach for the ride.
You do. The real takeaway from this cycle, I think, isn't just the ups and downs. It's TL's ability to maintain its leadership and strategic investments through those downturns, like in FY 2024, emerging stronger when the market inevitably recovers, like in FY 2025.
Right. So despite that revenue volatility, you said TL has consistently delivered high profitability. That's a pretty powerful statement about their market position and their management, isn't it? What does that profitability trend tell us?
It's a really strong testament to their market position and their disciplined operations, absolutely. Their gross margin, for instance, has shown this steady upward trend right through that volatile cycle. It expanded from 40.4% back in FY 2021 to a record 47.1% in FY 2025.
Getting more profitable on each sale.
Exactly. This sustained improvement suggests strong pricing power, likely from those advanced tools, and an increasingly favorable mix of high-value added products in their sales.
And operating margins. Did they hold up during the downturn?
They did remarkably well. Operating margins have also been robust, peaking at nearly 30%, 29.9% back in FY 2022. But even during that significant FY 2024 downturn, when revenue fell 17%, the company maintained a highly respectable operating margin of 24.9%.
Still almost 25% margin in a down year. That's impressive.
It really is. Before recovering strongly to 28.7% in FY 2025, the ability to protect profitability like that during a substantial revenue decline highlights, I think, the company's somewhat variable cost structure and very disciplined expense management. They control costs well.
And what about returns to shareholders, ROE?
Yeah, when we look at shareholder returns, TL has consistently generated acceptable return on equity, or ROE. It's remained well above 20% throughout that entire 5-year period we just walked through. It reached a peak of 37.2% in FY 2022 and rebounded to 30.3% in the most recent fiscal year, FY 2025. That's top-tier performance.
Consistently over 20%, often over 30% ROE. Very strong.
Very strong. And its trailing 12-month return on invested capital, or ROIC, as of September 2025, was also strong at around 23.19%. These metrics really show they generate high returns on the capital invested in the business.
Okay, those are impressive numbers, especially the cash flow generation you mentioned earlier and that balance sheet strength. A debt-free balance sheet in such a capital-intensive industry, is that always ideal? Or could one argue they're actually being a bit too conservative? Maybe they could use leverage to grow even faster.
That's a really perceptive question, and it's a debate you sometimes hear. TL is undeniably a formidable cash-generating enterprise with an exceptionally strong balance sheet. Cash flow from operating activities has shown really strong growth, increasing from about JPY 146 billion in FY 2021 up to JPY 582 billion in FY 2025. That's almost a 4-fold increase in operating cash flow.
Huge growth in cash generation.
Yeah. And this robust cash generation allows the company to self-fund its aggressive R&D and capital expenditure programs while simultaneously returning significant capital to shareholders. It's also worth noting that their net income and cash from operations track each other pretty well, with cash flow often being higher, which is generally considered a sign of high-quality earnings. The cash is really coming in.
Good sign. And the balance sheet specifics.
As of March 31st, 2024, the company's balance sheet was, as I said, pristine. Total assets of JPY 2.46 trillion. They held a substantial cash and cash equivalents position of JPY 461.6 billion, lots of cash on hand.
Almost half a trillion yen in cash.
Yeah. And critically, as we discussed, the company operates with essentially no debt. Their debt-to-equity ratio is effectively zero. Now, to your question about conservatism, while some might argue that taking on strategic debt could perhaps accelerate growth or fund large acquisitions, for TEL, this financial fortitude is viewed internally and by many analysts as a major strategic asset.
Wow, so.
It provides maximum flexibility, it allows them to navigate the inevitable downturns and invest opportunistically, maybe acquiring technology or talent, without the constraints or risks of servicing debt. It acts as a massive buffer, allowing them to fund that huge R&D budget aggressively without relying on external financing, which is a powerful advantage in a cyclical industry where borrowing might get expensive or difficult right when you need it most.
Right, financial flexibility is its own reward in a tough market. Yeah. So, with all this financial strength, how does Tela actually balance reinvesting in growth, that massive R&D budget, with returning money to you, the shareholder? What's their philosophy there?
They seem to have a clear and balanced philosophy. The company has a stated dividend policy with a target payout ratio of 50% of net income.
50% payout, okay.
Yeah. This approach ensures that dividend payments are sustainable and directly aligned with the company's cyclical earnings power. So while the absolute dividend amount might decrease during a severe downturn if earnings fall, it's a prudent policy that prioritizes long-term financial health over maintaining a fixed payout they might struggle to afford.
Variable dividend based on profits. Makes sense.
Exactly. As of September 2025, the stock offered a dividend yield of approximately 2.53%. Now, in addition to dividends, TEPEL also returns capital through periodic share repurchase programs. For example, they recently announced a plan to repurchase up to 3.5 million shares, which led to a slight decrease in the total number of shares outstanding year over year.
Buybacks too, so a mix of dividends and buybacks.
Yes, it's a balanced, disciplined approach that really speaks to a mature management team focusing on both growth and shareholder returns.
Okay, and just for a quick summary of those key numbers again, referencing the data we have from Table 1. Net sales for FY 2021 were around JPY 1.4 trillion, 1,399.1 billion, growing impressively to JPY 2.4 trillion, 2,431.5 billion in FY 2025.
Big jump.
Gross profit margin expanded nicely from 40.4% to 47.1% over that period. Operating margin moved from 22.9% up to 28.7%. Their ROE was strong throughout, 26.5% in FY 2021 and 30.3% in FY 2025. And that key indicator, R&D expenses, nearly doubled from JPY 136.6 billion to JPY 250.0 billion over the same 5 years.
Yeah, the numbers really tell a story of growth, increasing profitability, and heavy reinvestment. #TAG-V. Recent developments in industry headwinds, 2023, 2025, navigating the storms. So this brings us to some really important recent context. What's the most significant and, frankly, unpredictable external challenge facing TL right now? It's undoubtedly that escalating technological rivalry between the U.S. and China.
The geopolitical dimension.
Exactly. Since 2022, the U.S. government has implemented increasingly stringent export controls aimed at restricting China's access to advanced semiconductor technology and, crucially, the equipment needed to produce it. These regulations primarily target the leading-edge stuff, say below 14 nanometers, and specific Chinese entities like SECMEC, but they have a far-reaching impact.
Affecting everyone, not just U.S. companies.
Right. It affects not only U.S. firms, but also crucial international suppliers, including Japan's TL and Europe's ASML. The impact on TL specifically is incredibly complex. It's not straightforward.
How so?
Well, on one hand, these restrictions directly limit the company's ability to sell its most advanced equipment into China. Management has stated that less than 50% of its products are affected by the current rules, which implies that a significant portion of its portfolio, likely geared towards those more mature nodes, can still be sold into China.
Okay, so they can still sell some stuff, just not the top-tier tools.
Right. But here's the twist. On the other hand, these very restrictions seem to have inadvertently fueled a massive surge in demand for that mature node equipment within China. Chinese firms, facing restrictions on advanced tech, poured money into import substitution and building domestic capacity in the non-sanctioned technologies they could access.
So China, blocked from the cutting edge, doubled down on building out its domestic capabilities for everything else, like automotive chips, industrial chips.
Exactly, and TL, being a major supplier of those mature node tools as well, benefited significantly from that boom. This dynamic really explains why China's revenue share for TEL sometimes exceeded 40% in prior quarters. It was a bit of an unintended consequence of the controls.
A counterintuitive boom, But then we saw that decline back to 34.3% in Q4 FY 2025. What happened there? Did the boom run out of steam?
That's the recent shift, yeah. Management attributed it, as we mentioned, to a combination of a pull forward of shipments getting orders out the door early and that peak out of capital investment by emerging customers in China.
So maybe the panic buying or initial rush is over?
It could be. What it essentially suggests is that the initial wave of catch-up investment by Chinese firms might be moderating. Or perhaps another factor could be that the Chinese domestic supply chain for those mature node tools is starting to develop some capabilities of its own, reducing reliance on imports over time.
Domestic competition starting to emerge in China.
It's a possibility, especially for the less complex equipment. The implication here is a high degree of uncertainty going forward. The potential for further U.S. restrictions or maybe Chinese retaliatory measures poses a constant risk to what is still a very significant portion of TEL's business. It's truly a geopolitical minefield they have to navigate very, very carefully.
Yeah, sounds incredibly tricky. Now, beyond geopolitics, the industry has its own natural rhythms, right? We saw that tough downturn in the memory market recently, but also a swift and powerful recovery. It really is like the industry's own pulsating heartbeat.
It really is.
Yeah.
The semiconductor industry is subject to these periodic inventory cycles, and the memory segment, that's DRAM for computers and servers, NAND flash for storage, is particularly volatile. Swings can be dramatic. In 2023, the memory market experienced a really severe downturn.
What caused that one?
It was caused by a combination of factors: post-pandemic demand weakness for PCs and smartphones, which use a lot of memory, and also a significant oversupply of inventory that had built up at the major manufacturers like Samsung, SK Hynix, Micron.
Too much supply, not enough demand. Classic cycle.
Classic cycle. And as a key equipment supplier to those memory giants, this directly impacted TL. That downturn in memory-related capital expenditures was a primary driver for TL's 17.1% revenue decline in its 2024 fiscal year. Memory spending just dried up for a while.
But it came back strong here.
Oh, yeah. Beginning in late 2023 and really accelerating through 2024 and into 2025, the memory market has entered a very strong recovery phase. This rebound is driven partly by the normalization of those inventory levels, but more importantly by surging demand for high bandwidth memory, HBM.
HBM, that's the stuff needed for AI chips.
Exactly. It's absolutely essential for AI accelerators, the GPUs and custom chips powering the AI revolution. HBM demand is just exploding. The World Semiconductor Trade Statistics, WSTS, forecasts solid 13% memory market growth overall in 2025, and major producers like SK Hynix and Micron are projecting significant increases in their capital expenditures for the year, much of it focused on HBM capacity.
So the memory cycle is now a tailwind again.
A very strong tailwind. This cyclical upswing in the memory market is a key factor behind TTEL's record-breaking revenue performance in its 2025 fiscal year. It's a powerful reminder of how quickly this industry can turn both down and up.
So in the face of these significant and really dynamic challenges to geopolitics, these market cycles, how has TEL's management actually responded? Are they just reacting to events, or is there a more proactive strategy at play here?
That's a crucial question. TEL's management has shown, I think, a clear strategic focus on maintaining that long-term technological leadership and also on diversification. Recognizing that R&D is the absolute lifeblood of this industry, they maintained an aggressive investment posture even through the downturn. Remember, R&D expenses kept rising, hitting that JPY 250 billion mark in FY 2025, despite the revenue dip in the prior year.
Investing through the cycle.
Yes. This commitment ensures that TEL is well-positioned with the next-generation tools ready to capture demand as the market recovers and as crucial technology inflections like new transistor types occur. They're playing the long game.
And diversification. You mentioned their heavy reliance on certain regions and customers.
Exactly. Concurrently, management is taking tangible steps to strategically diversify its operational footprint beyond its traditional strongholds in Japan, Taiwan, and Korea. A key recent development is the establishment of a new development hub in Bengaluru, India.
India. Interesting move. What's the focus there?
This site will focus on critical areas like software development for their complex equipment and also equipment simulation, which is vital for designing and testing tools virtually. This move serves multiple strategic purposes. First, it allows TTEL to tap into India's deep pool of specialized engineering talent, particularly in software.
Makes sense. India is strong in software.
Right. Second, it supports the Indian government's ambitions to build a domestic semiconductor ecosystem. You see projects like Tata Electronics' new fab getting underway there. TEL being present helps enable that. And third, importantly, it acts as a strategic hedge. It reduces the company's long-term operational reliance on any single geographic region, which looks pretty smart in today's world of increasing supply chain fragility and geopolitical risk.
Diversifying their R&D and talent base geographically.
Precisely. And it's worth noting that their focus remains on organic growth through R&D. There haven't been any significant recent acquisitions mentioned in the sources. They're building, not buying, their future capabilities, it seems. #SEPAG sucks. Growth opportunities and future outlook. The road ahead for semiconductors.
Okay, let's shift focus now and look ahead. The demand for more powerful, more efficient semiconductors seems absolutely relentless, doesn't it? Constantly pushing the limit of physics. What are the major technological shifts right on the horizon that you see fueling Tetl's growth in the coming years?
Yeah, the demand is insatiable. The explosive growth of AI is arguably the single most important demand driver right now and likely for the foreseeable future. It's creating just an unprecedented need for that high bandwidth memory, HBM, we just discussed.
Because AI models need massive amounts of data processed very quickly.
Exactly. HBM achieves its high performance by using advanced packaging techniques, specifically stacking multiple DRAM memory chips vertically, 3D stacking. These processes, building these complex 3D structures, are highly intensive in deposition and etch steps.
Deposition and etch core competencies for TTEL.
Right in their sweet spot. To give you a sense of the magnitude here, one of Telltale's main competitors, Lam Research, anticipates its revenue from tools specifically for advanced packaging will more than double to over $3 billion in the coming years. That highlights the immense opportunity for the entire equipment sector, including TL, just from this one trend.
Okay, so HBM and advanced packaging, driven by AI, is a huge tailwind. Makes sense, given their expertise in deposition and etch. But what about something even more fundamental, like the transistors themselves? I keep hearing about gate-all-around, or GAA transistors. That sounds incredibly technical. What exactly is that, and why is it such a potential game-changer for a company like TL?
That's a crucial inflection point happening right now at the leading edge. Moving to gate-all-around, or GAA, transistors for the 3nm and upcoming 2nm nodes is a massive architectural shift from the FinFET design that's dominated for the last decade or so.
FinFET to GAA. Okay, what's the difference?
Imagine designing a tiny wire, which is essentially what a transistor channel is. In FinFET, you control the current flowing through that wire, that fine, from three sides, like gripping it from the top and sides. GAA takes it a step further. It allows chip makers to wrap the control gate, the switch around all four sides of tiny nanowires or nanosheets.
Wrapping all the way around.
All the way around. This gives you unparalleled precision in controlling the current flow, leading to better performance and lower power consumption at these incredibly small scales. But, and here's the key part for Tela, building that all-around structure at an atomic scale demands entirely new levels of complexity in deposition and etch. You need more steps, more precise steps, more complex materials.
So harder to build means more work for Tel's machine.
Exactly. This fundamental architectural change directly increases demand for Tel's most advanced deposition and etch tools, where they already hold significant market share. It literally requires more layers, more etching, more cleaning, more of what Tel sells.
Got it. More complexity equals more opportunity for the tool makers.
Precisely. And finally, let's not forget EUV lithography, where Tel has its unique coder-developer monopoly. EUV is expanding rapidly. It's becoming the standard for a growing number of layers, not just in advanced logic chips, but also increasingly in DRAM memory manufacturing.
So more EUV machines being used. More EUV machines being sold by ASML, and each machine being used for more layers within the chip manufacturing process. This means direct, strong, almost guaranteed growth for Tel's EUV coder developer systems, growing essentially in lockstep with the expanding installed base of ASML's EUV tools. Every ASML EUV system sold basically means another Tel coder developer system is needed alongside it.
That's a pretty direct link to growth.
A very direct link.
So while all that cutting-edge technology like AI, GAA, and EUV grabs the headlines, the expansion into more established and emerging industries also provides a broad and, maybe more importantly, durable base of demand, right? What about the growth we're seeing in automotive and IoT applications? How does that impact a company like TLL, which is often associated with the most advanced stuff?
You're absolutely right. That broadens the demand base significantly, and it's crucial for stability. The transformation of the automotive industry towards electric vehicles and autonomous driving is profoundly increasing the semiconductor content per car.
We talked about that cars becoming computers on wheels. Exactly. And this isn't just about the super advanced processors for ADAS or self-driving. It also involves a wide range of other chips. Power semiconductors for managing batteries and motors, countless sensors, microcontrollers for everything from window controls to infotainment systems. The automotive semiconductor market itself is projected to grow from roughly $81 billion in 2024 to nearly $116 billion by 2029.
That's substantial growth in just 5 years.
It is, and this provides a steady, long-term growth driver for the equipment needed to produce these chips. And importantly, many of these automotive chips are produced on more mature process nodes, not always the absolute cutting edge. Tel has strong offerings and significant market share in equipment for those mature nodes as well, so it benefits across the spectrum.
Good points, not all leading edge. And IoT.
Similarly, the Internet of Things, or IoT, continues its ongoing proliferation. Connected devices in homes, factories, cities, billions and billions of them. This creates a long-tail demand for vast quantities of relatively mature node semiconductors, sensors, simple processors, connectivity chips. While the value per chip might be lower than a high-end GPU, the sheer volume represents a significant and growing market.
Volume play.
Exactly. It supports high levels of fab utilization globally and drives steady demand across Tel's entire product portfolio, again, including tools for those mature processes. It's like the consistent underlying hum of demand that keeps fabs busy day in, day out.
Okay, that makes sense. Broad-based demand.
Yeah.
And we're also seeing this significant global trend you mentioned earlier, onshoring and friendshoring of semiconductor manufacturing. What does that really mean in practice, and how does a Japanese company like Tel benefit from, say, the US or Europe trying to build more fabs? It feels like a global rebalancing act.
It really is a global rebalancing act, and it's a direct response, as we discussed, to recent supply chain disruptions during the pandemic and, of course, those rising geopolitical tensions. Governments globally have woken up to the strategic importance of semiconductors.
National security implications.
Absolutely. So major legislative acts like the U.S. CHPS and Science Act, the European Chips Act, and India's Semiconductor Mission are providing tens of billions of dollars in subsidies and incentives. The goal is clear. Incentivize the construction of new, modern fabrication facilities outside the traditional hubs, primarily Taiwan and South Korea.
Spreading the manufacturing footprint more widely.
Exactly. The implication here for equipment suppliers like Tel is a significant geographic diversification of wafer fabrication equipment spending over the next decade. It's creating substantial new growth opportunities as these new fabs get built and equipped in regions that haven't seen this scale of investment before.
So new customers in new places.
Essentially, yes. Or existing customers building in new places. And Tel is actively positioning itself to capitalize on this shift. We already mentioned their new development center in India. They're also undertaking new construction in Miyagi, Japan, likely to support domestic capacity expansion as well. The bottom line is, Tel will be a primary beneficiary of both the initial tooling phase, when these new fabs are first filled with equipment, and the subsequent expansion phases as these new facilities ramp up production in North America, Europe, and potentially India. It's like a whole new wave of infrastructure build-out, but for the most advanced manufacturing on Earth, happening on a global scale. Hashtag TAG7, capital allocation and management quality. The architects of success. You know, the quality of a company's management team is absolutely paramount, especially in a complex, cyclical, and capital-intensive industry like semiconductor equipment. And based on the materials, Tel's management demonstrates a very disciplined and, I think, forward-looking approach to capital allocation, clearly prioritizing long-term technological leadership.
How does that show up in their decisions? Where are they putting the money?
Well, the most critical investment for any wafer fabrication equipment company is research and development. It's the lifeblood. Tel's spending in this area has been both substantial and consistently increasing, as we noted. It rose from about JPY $137 billion back in fiscal year 2021 to a budgeted JPY $250 billion in fiscal year 2025.
Almost doubling R&D spend in 5 years.
Yeah. And furthermore, management has outlined that strategic plan to invest a massive JPY 1.5 trillion, again, over $10 billion in R&D over the 5-year period starting in FY 2025.
That JPY 1.5 trillion over 5 years for R&D is just an incredible figure. What does that signal to the market beyond just we spend a lot, and what's a tangible output you expect from that kind of spending?
It signals immense confidence in their future opportunities and a fierce determination to stay ahead. That aggressive reinvestment rate is a clear positive signal of management's focus on maintaining and extending its technological moat. It's not just about spending money defensively. It's about anticipating the next major technology inflections, like the shift to gate-all-around transistors or maybe the next evolution beyond EUV eventually, and ensuring they have the cutting-edge tools ready when chip makers need them.
So it's both defense and offense.
Absolutely. It's a defensive strategy to protect their current leadership positions and an offensive strategy to capture future growth opportunities presented by new technologies. The tangible output should be next-generation etchers, deposition systems, coder developers that enable those future chips.
Okay, so R&D is priority number one. What about building factories, labs, capital expenditures, or CapEx?
Right. To support those huge R&D efforts and also expand their own manufacturing capacity to meet growing demand, the company is also significantly increasing its capital expenditures. CapEx has grown from about JPY 54 billion in FY 2021 to JPY 162 billion in FY 2025. In that last fiscal year, CapEx was roughly 28% of their cash flow from operations.
So spending heavily on buildings and equipment, too.
Yes. These investments are going into things like new development facilities, advanced evaluation equipment needed to test the next-gen tools, and expanding their production sites. These are essential investments for developing and building the tools of the future. They're primarily investments for growth and innovation, not just for maintaining the status quo.
Okay, so massive spending on R&D, significant spending on CapEx for future growth. After funding these crucial growth initiatives, how do they balance that with returning capital to shareholders? Is it a case of growth at all costs, or do they make sure to share the wealth along the way?
No, it appears to be a very balanced approach, actually. After funding these critical growth initiatives, management is clearly committed to returning capital to shareholders. This is primarily achieved through dividends, as we discussed, with that stated target payout ratio of 50% of net income.
The 50% target.
Right. And this is supplemented by opportunistic share repurchases. We mentioned the recent plan to repurchase up to 3.5 million shares, which has led to a slight decrease in the total number of shares outstanding year over year, benefiting remaining shareholders. This balanced approach invests heavily in the future but also return a significant portion of profits is characteristic, I think, of a mature and disciplined management team that understands the importance of both long-term investment and shareholder alignment. They're not hoarding cash unnecessarily.
That's reassuring. It's always good when a company's leadership lays out a clear and ambitious vision for the future, too. What are TL's guiding stars? Do they give specific targets, and how do they communicate their strategy?
Yes, they do. TEL's leadership has articulated some clear and quite ambitious long-term financial targets for the fiscal year ending in March 2027. They're aiming for net sales of JPY 3 trillion or more. Remember, they just hit JPY 2.4 trillion, so that's significant growth.
Yeah, another big jump implied there.
Definitely. They're targeting an operating margin of 35% or more, up from the current 29%, and a return on equity of 30% or more, which they've already achieved recently but are aiming to sustain.
Setting the bar high.
They are. Setting such specific, measurable, and ambitious goals provides a very clear framework for investors like you to evaluate their performance over the next few years. And it demonstrates a high level of confidence from management in the company's long-term prospects. In terms of communication, they also maintain a high standard. They regularly host investor days, provide very detailed quarterly earnings materials, and crucially, they do this in both Japanese and English, ensuring transparency for global investors regarding their strategy, performance, and outlook.
Good transparency. What about corporate governance? How is the company structured and overseen? Any red flags there?
In terms of corporate governance, Tokyo Electron employs a kind of hybrid model. It blends some traditional Japanese practices, like having a statutory audit and supervisory board, with more global standards, such as having independent nomination and compensation committees staffed by outside directors.
Independent committees are generally seen as a positive.
Yes. And a key feature is that a majority of the board of directors consists of outside directors, which is intended to enhance oversight and independence from management. They also emphasize transparent and timely information disclosure in both Japanese and English. Generally, this modern governance framework is viewed favorably by international institutional investors. It promotes accountability and alignment with shareholder interests. No major red flags seem apparent from the sources.
Okay, sounds pretty solid. And management's own motivations, are they aligned with shareholders? Do they have skin in the game?
Management's motivations appear to be strongly aligned with shareholders, primarily focused on achieving that long-term growth and profitability they've targeted. The CEO, Toshiki Kawai, directly owns about 0.028% of the company's shares. Now, that percentage might sound small, but given TEDL's market cap, it was valued at approximately $18.8 million recently. That's certainly a significant personal incentive to increase shareholder value.
Definitely puts him in the same boat as other shareholders.
It does. And their overall compensation policy, which is overseen by that compensation committee with a majority of outside directors, was actually revised for FY 2025, specifically to increase the proportion of stock-based compensation for executives. This further strengthens the link between executive pay and the company's long-term performance and share price. So the incentives seem well aligned. Hashtag tag 8. Valuation analysis, the price tag. Okay, let's talk valuation. Valuing a company in a deeply cyclical industry like semiconductor equipment is definitely more art than science sometimes. A simple price to earnings, or PE ratio taken at any single point in time, can be really misleading because the earnings, fluctuates so wildly through the cycle.
Right, the PE looks crazy high at the bottom of the cycle and maybe deceptively low at the peak.
Exactly. So we need a more nuanced approach. Looking historically, TEL's annual PE ratio has shown this volatility. It's ranged from a low of around 10.8 back in 2019 up to a cyclical peak of 48.9 in 2024. That was when earnings were temporarily depressed by the industry downturn, making the PE look huge.
Almost 50 times earnings.
Yeah.
But that was misleading.
Very misleading. Now, as of September 2025, with earnings having strongly recovered in FY 2025, the company's trailing PE ratio stood somewhere in the range of 17x to 19x.
Okay, 17 to 19 times trailing earnings now. How does that compare historically for TLO?
Historically, that's actually below its 10-year historical average PE, which is approximately 21x. So what this suggests, at least on a historical basis, is that the stock is not trading at a significant premium to its own long-term valuation trend, especially considering the strong recovery in earnings we've just seen. It doesn't look overly expensive compared to its past.
Okay, interesting. So how does TL's current valuation compare to its closest rivals in this WFE oligopoly? Are we seeing a discount or a premium here relative to peers? And if there's a difference, why might that be?
Right. A relative valuation analysis against its primary competitors provides really crucial context. Looking at trailing 12-month data from around mid-September 2025, TEL's market cap is roughly $63 billion US dollars. Now that's significantly smaller than Applied Materials at around $134 billion, Lam Research at $146 billion, and KLA Corporation at $123 billion. So TEL is the smallest of that big four group by market cap.
Considerably smaller, yeah. And valuation multiples, PE.
In terms of PE ratio, TEL trades around 17.0x on that trailing basis. As we saw, that's generally at a noticeable discount to Lam Research, which was trading around 27.9x, and KLA Corporation at 31.8x. It's more in line with, or perhaps slightly cheaper than, Applied Materials, which is around 20.0x.
So a discount to Lam and KLA, similar to AMAT. What about other multiples?
We see pretty similar trends with other common multiples. On an EV to EBITDA basis, TEL was around 12.0x compared to AMAT at 14.9x, and Lam Research much higher at 23.0x. On a price-to-sales ratio, TEL was around 3.8x versus AMAT at 4.8x, Lam at 8.1x, and KLA way up at 10.4x. So consistently trading at lower multiples than Lam and KLA, and roughly in line with AMAT.
Okay, but how does their actual profitability compare? Are those lower multiples justified by lower margins or returns?
That's the key question. When we look at profitability, TL's gross margin around 46.8% recently, and its operating margin at 27.9% are broadly comparable to Applied Materials, 48.5% gross, 30.1% operating, and Lam Research, 48.7% gross, 32.0% operating.
They're all playing in a similar profitability range.
So similar profitability to AMAT and Lam, despite the lower valuation multiples for TEL relative to Lam. Generally, yes. KLA's higher margins, remember, 60.9% gross, 41.3% operating, reflect its specialized higher margin niche and process control. Now, looking at return metrics, TEL's return on equity, ROE at 29.4%, and return on invested capital, ROC at 23.2%, are very strong. They're generally comparable to or even better than Applied Materials, although they're lower than Lam Research, 62.7% ROE, and KLA, an astonishing 102.6%. Partly due to differences in capital structure and business models, Lam and KLA are perhaps less capital intensive in some ways.
Okay, so putting it all together.
The analysis really reveals that TEL trades at a noticeable discount to Lam Research and KLA, while being more in line with Applied Materials despite having broadly comparable profitability to its direct broad-based competitors, AMAT and Lam. What could this mean? Well, this discount may suggest that the market is not fully appreciating the strength and durability of TEL's competitive moats, particularly that near-monopolistic EUV coater developer position, which is such a critical choke point in advanced chip manufacturing.
So for you, the listener, this could imply that TEL is potentially undervalued relative to its peer group, given its robust fundamentals and strategic importance.
It's certainly an argument that could be made based on this comparative data. The market might be overly focused on the cyclicality or the China risk, perhaps, and not giving full credit to the moat.
Interesting. Now, given that industry cyclicality we keep hammering on, how should investors think about earnings power? Focusing on just the last year, whether it was a peak or trough, seems risky.
Absolutely. Given the industry's pronounced cyclicality, it's much more robust, I think, to try and estimate what TEL can earn on average, through a full cycle, rather than focusing solely on peak numbers like FY 2025 or trough numbers like FY 2024. This approach involves assessing the company's sustainable level of profitability over time.
Normalized earnings power, basically.
Exactly. Think of it like trying to predict the average temperature for a city that has very hot summers and very cold winters. You wouldn't base your long-term plans or clothing choices on just one extreme day, right? You'd look at the average.
Makes sense. How would you estimate that for TL?
Well, looking back over the recent full cycle we discussed, from fiscal year 2021 to 2025, TL demonstrated the ability to maintain operating margins somewhere between 22.9% in the run-up and 29.9% at the peak, and even held near 25% in the downturn year. So, based on that history and their strategic position, a conservative and reasonable estimate of a normalized operating margin might fall somewhere in the, say, 25% to 28% range.
Mid to high 20s as a sustainable average function.
Yeah, something like that. And applying this normalized margin range to a sort of mid-cycle revenue forecast, maybe an average of the FY 2024 trough revenue and the FY 2025 peak revenue, or looking at analyst consensus forecasts for a couple of years out, can provide a more stable and arguably more reliable estimate of the company's true underlying earning capacity for valuation purposes. It helps you look beyond the inevitable short-term noise of the cycle. #TagIX. Key risks and considerations. What could derail the trajectory? Of course, no investment analysis, especially a deep dive like this, would be complete without a rigorous assessment of the potential risks. What could derail TEL's trajectory? What could adversely affect its business operations, financial results, or market valuation?
Right. The flip side of the opportunity. What keeps management up at night?
Well, the most fundamental risk, and we've highlighted this repeatedly, is the inherent cyclicality of the semiconductor industry itself. It's just structurally prone to these boom-bust cycles driven by swings in capital investment and occasional periods of overcapacity. TL's 17.1% revenue drop in fiscal year 2024 serves as a very recent and stark reminder of this vulnerability.
Can't escape the cycle.
You really can't. The timing of investments within this cycle is therefore a critical variable for any investor considering TL or any other WFE stock. Buying at the peak of the cycle can lead to near-term pain.
Okay, cyclicality is risk number one. What's next? Geopolitics.
Absolutely. This is probably the biggest, most unpredictable external risk TLO faces. That escalating tech rivalry between the United States and China, which places the semiconductor equipment industry squarely in the crosshairs. We've seen how U.S. export controls have impacted them already.
Yeah, the complex impact on their China sales. What if those restrictions tighten further? Could they get worse?
That's the big wild card, isn't it? Further tightening of U.S. export controls is always a possibility. They could potentially expand restrictions to cover more mature process technologies, not just the absolute cutting edge. If that happened, it would directly and severely impact TDL's revenue, given that China remains its largest single market, even at 34%.
A major blow if mature node sales were restricted.
A major blow. Furthermore, there's a persistent risk of retaliatory measures from China. They could potentially restrict exports of critical materials needed for chip making or launch investigations into foreign firms operating in China. Either could disrupt the entire global supply chain, impacting TL and its customers. It's a truly unpredictable and high-stakes geopolitical environment. TL has to navigate this incredibly carefully.
Yeah, walking a tightrope. What about their customer concentration? Rely on just three giants, Intel, TSMC, Samsung, for over 43% of revenue. That sounds like a big vulnerability, too. Is that just the nature of the beast in this industry, or is it a specific risk for TDL?
It's somewhat inherent to the high end of the WFE industry, where only a few companies operate the most advanced fabs, but it's still a significant risk factor, absolutely. As you said, TEL derives a substantial portion of its revenue from just those three major customers. A decision by any one of these key customers to, say, delay a major new fab project, significantly reduce their overall capital expenditure budget for a year, or perhaps most damagingly, successfully design TEL's equipment out of a critical process step in favor of a competitor's tool.
Ouch. Losing a spot at TSMC or Intel would hurt.
It could have a material and immediate negative impact on Telos' financial results. While the relationships are deep and sticky, as we discussed, this concentration definitely introduces specific vulnerability. They're heavily reliant on the spending plans of just a few behemoths.
Okay. What about the technology itself? Can they be leapfrogged?
That's the constant race they're in. The semiconductor industry is defined by this relentless pace of technological innovation. TEL's competitive advantage absolutely depends on staying at or very near the forefront. So there is a constant risk that a competitor, maybe Applied Materials, Lam Research, or even a new player, could develop a breakthrough technology in one of TEL's core markets, like etch or deposition, offering superior performance or a significantly lower cost of ownership.
That disruptive innovation.
Exactly. Or perhaps even more fundamentally, the emergence of a completely new manufacturing paradigm. Maybe something based on photonics or a different material system that reduces the need for traditional silicon process steps could threaten their existing product lines over the very long term. Now, this is precisely why TEL's high and sustained R&D spending is not just a growth driver. It's a critical defensive necessity. It's a perpetual arms race to avoid obsolescence.
Always looking over their shoulder while trying to run ahead.
That's a good way to put it. One more risk worth mentioning is foreign exchange exposure.
Currency risk. How does that affect them?
Well, while Tokyo Electron mitigates direct transactional risk by denominating the majority of its export sales in Japanese yen, meaning they get paid in yen, they're still exposed to the broader economic impact of major currency fluctuations. A sustained and significant appreciation of the yen against the US dollar and other major currencies would effectively make Telos products more expensive for its global customers when compared to its primarily US-based competitors like Applied Materials and Lam Research.
Making them less competitive on price if the yen gets too strong.
Exactly. This could put pressure on its market share or force Tel to reduce its yen prices to stay competitive, thereby compressing its profit margins. It's a background factor, but significant currency swings can have an impact.
Okay, so quite a few significant risks: cyclical, geopolitical, customer concentration, technology, currency. But despite these, it feels like the risk of this company actually, failing completely is pretty low.
I would agree. It's important to put these risks in perspective. The risk of a catastrophic loss, meaning the investment going to zero, seems extremely low here. TEL is a dominant global leader in a critical growing industry. It's highly profitable, generates strong cash flow, and crucially, has that debt-free balance sheet. Its Altman Z-score, which is a measure of bankruptcy risk, was recently calculated at 14.01. Anything above 3 is generally considered safe, so 14 is indicating a very, very low risk of financial distress.
So barring some black swan event.
Exactly. A catastrophic loss would likely require an extreme low-probability event, something like a major military conflict in East Asia, severely impacting its key customers and supply chain simultaneously, or perhaps a truly paradigm-shifting technological disruption that somehow renders its entire portfolio of etch, deposition, and lithography support tools obsolete almost overnight, which seems highly unlikely given their R&D.
Right, and one final point from the analysis: undervalued assets. What does that refer to?
Yeah, this is an interesting point, often overlooked in standard financial analysis. Looking strictly at the balance sheet, it's likely that TEL has significant assets that are not fully recognized at their true economic value. The prime example is its intellectual property and other intangible assets. While the balance sheet might list intangible assets at, say, JPY 32.4 billion, that accounting value is almost comically low compared to its real worth.
Because the value isn't in the paper the patent is printed on.
Precisely. The true insight is that TEL's 23,000 plus patents, its decades of accumulated proprietary know-how, the deep, sticky customer relationships built on trust and collaboration, the tool of record status that creates those high switching costs, these are immense, incredibly valuable assets. They contribute significantly to its durable competitive moat, but are often vastly understated by conventional accounting rules. They represent a significant hidden strength, arguably. #outro.
Well, we've certainly covered a lot of ground today. We've navigated the intricate world of Tokyo Electron, haven't we? From its critical, often unsung role as a supplier of that cutting-edge wafer fabrication equipment,
Absolutely essential stuff.
to its powerful competitive moats, particularly that fascinating 100% share in EUV coder developers, and its resilient financial performance, managing to thrive even through those challenging industry cycles.
Yeah, the roller coaster ride.
We've explored the exciting tailwinds, AI chips, advanced packaging, automotive growth, carefully balancing them against those significant headwinds. the geopolitical tensions, especially around China, and the inherent cyclical risks of the semiconductor industry.
It's a complex picture, for sure. So maybe here's a provocative thought for you, the listener, to consider as we wrap up. As global powers increasingly view semiconductors not just as an economic advantage, but as a fundamental matter of national security, how will companies like Tokyo Electron, which are truly global players, continue to balance their worldwide operations and deeply interconnected supply chains with this accelerating pressure for regional self-sufficiency, for onshoring?
That's a great question. Can they serve everyone in a fragmenting world?
Exactly. What does this tension mean for the future of technological collaboration versus competition on a global stage? It's a huge strategic challenge for companies like TSE, and the outcome will shape the industry for years to come.
Definitely something to chew on. Well, hopefully this deep dive has armed you with a robust understanding of Tokyo Electron's place in our digital world, its strengths, its challenges, its opportunities. Now it's your turn, as always, to continue learning, asking questions, and connecting these dots, because the story of technology, as we know, is constantly evolving.